So a lot of traders, they don't know this, but when they're going in and putting a trade and they put a stop, below a bar or something like that, the market makers can actually run the price down and hit your stop and then run back up, okay, and be where it was momentarily before, okay. They can do this because they can see where your stops are. And as always, guys, make sure you hit the bell notification icon and hit the like button. Make sure you smash that like button for the YouTube algorithm to work. As I mentioned before, when I upload my next video, I'm going to be around for the first 60 minutes to answer all your questions live. If it was the real market, that won't happen. So that's why a lot of beginner traders, they don't understand the difference between the two. They end up losing money every time they go in and put their stops there. Another common problem trading with a market maker is that they can actually give you requotes, okay, or provide you with big slippages that can end up costing you a lot of money. Now, the big reason why market makers actually don't put your trades through directly to the market is because they know that you're a beginner, and they also know statistically that 99% of traders lose money. So knowing that, if you're going to fund your account with $1,000 or $5,000, they know that within the next 3 to 6 months, you're going to lose your money. So instead of them putting it directly to the market where your money flows on to other traders, they will keep your money, trading against them. And through statistics, they know that you're going to lose all your money within the next 3 to 6 months. They would actually allow you to trade and slowly dwindle your account that way. Now, with that being said, they don't do all these kind of things often, as in like running your stops and things like that, okay? If you're just starting out, it's okay to use them. It's okay to use them to get your feet wet because they have a lower barrier to entry. So you can actually go in, start trading, get your feet wet, get used to the environment without outlaying a lot of money. The other difference between a market maker and a real brokerage company that trades direct to market is that the ones that are direct to market normally cost a lot more to have your account running every single month. You've got data feed fees, software fees, and other type little fees that can cost you quite a lot. So when you're just starting out and you don't have a lot of money, you don't want to be using these kind of companies, okay? So start with something small. You can use it, you can go in and you can use the market makers, and then when you start to make a decent amount of money, then you want to switch over from a market maker to another broker that is direct to market. Now, I primarily use NinjaTrader to trade the futures market only. I don't use them to trade the Forex market, even though you can trade Forex through them. There's a specific reason why I don't trade the Forex market through NinjaTrader. I'll explain that later in the video. So to recap, I use NinjaTrader to trade the futures market because they have nice charts, they're very clean, the software is very stable, and it's very easy to use. For the Forex market and for Forex trading, I use Go Markets. I love Go Markets. The software is very robust. They have different tiers when you're signing up an account with them. The first tier is the standard account. With their standard account, it's very good for beginners like you guys that are just getting started and getting your feet wet to go in and start trading with the small amount of capital. Even if you don't have any money, you can actually download the software and open up a demo account, okay, and start trading through the simulation that they have there. Now, the standard account actually has 0 commissions, but it actually has higher spreads. So at the end of the day, the brokerage company still has to make their money from you somehow, okay? So by giving them by them giving you 0 commissions, they still make money from you from having a higher spread. So what is the spread? The spread is the difference between the buy price and the sell price, okay? The higher the spread, the bigger it is the gap between the buy and sell price, and the more money that you have to use to buy in or sell out. So why can a large spread end up costing you more? The reason why it can end up costing you more is because you have to spend more to buy, and when it comes time to selling, okay, you actually sell it for a lot less when compared to the market price. So with that being said, 0 commission is actually not better for you because it can end up costing you more getting in and out. So the next time you see zero commissions, don't automatically think that that's better for you. I personally prefer zero spreads and paying a flat fee to get in and out, okay? Because when you do the numbers later on by yourself, you'll figure out that having zero spreads and a small flat fee would actually end up costing you less per round trip. So what does per round trip mean?